Every trader has heard it. Buy the top performers, sell the laggards. It's one of the most cited ideas in all of finance, supported by decades of academic papers and billions of dollars in institutional trades. But here's the real question. If you ran that same strategy today, in 2025, would it still work? I spent the past month rebuilding it, using real test and Norgate data to find out what's really left of this once legendary system. And the results might surprise you. So let's go step by step. The idea of this system came from an academic paper published in 2001. The rules were incredibly simple. Buy the best performing stocks from the past year, sell the worst performing ones, and rebalance every 3 months. That's it. From 1993 to 2001, this approach absolutely crushed the market, delivering an annual return of about 32% with a Sharpe ratio above 1.2. Those numbers were extraordinary, especially for such a basic strategy. But here's where things get interesting. The paper stopped in 2001, so I asked myself, what if we ran the exact same strategy forward? Through all the data we have until today, 2025? So I coded it in real test, used survivorship bias-free data from Norgate, added commissions and slippage, and made sure delisted stocks were included. And when I ran the same system forward, the performance collapsed. That's it didn't just underperform, it broke. Returns flattened, drawdowns got worse, and the once beautiful equity curve turned choppy and inconsistent. So the question became, why? What changed? The first thing I tested was the rebalancing frequency. Maybe 3 months was too slow. I tried switching to a monthly rebalance to catch momentum shifts earlier, but that didn't help either. In fact, the results got worse. Turnover exploded, costs increased, and performance declined even further. Next, I tried increasing diversification. Instead of holding 10 positions on each side, I went with 20. That didn't help either. The system just didn't respond. At that point, I suspected the look-back period might be the issue. The original paper used 1 year, 252 trading days, to rank stocks, so I tested multiple alternatives: 1 month, 3 months, 6 months, and around 200 days. The 200-day look-back gave the best performance among them, but it was still weak compared to a simple buy and hold in SPY. So clearly something structural had changed in the market since the late 90s. I went back to academic research and found a key clue in a paper by Novi Marks and another one by Alpha Architect called Quantitative Momentum Philosophy. I tested something mentioned in the literature, skipping the most recent month. Momentum tends to slightly reverse in the very short term, so many academic systems skip the last 20 trading days before ranking performance. I tried both versions, one with the skip and one without it. And although the difference wasn't huge, next I looked at rebalancing frequency again, monthly, quarterly, and annual. The 3-month and 6-month versions turned out to be the sweet spot. Monthly trading was too frequent and expensive, while annual rebalancing was too slow to react. Papers pointed out that momentum still works, but not everywhere. It tends to disappear in large, highly liquid stocks, because those are priced efficiently. Information spreads instantly, and any mispricing gets arbitraged away. In contrast, smaller, less liquid stocks still show signs of persistent momentum, because information takes longer to spread, and investors react more slowly. I wanted to know how volume itself influenced performance, so I grouped all trades by average trading volume and measured the returns. The relationship was very clear. Higher volume stocks had lower momentum returns. Lower volume stocks had stronger, more persistent gains. So I added one simple filter. I excluded all high volume stocks. Specifically, I kept only stocks with an average 20-day volume below 1 million shares, and that one change made a huge difference. Before I show the results, make sure you join my Substack. Every week I share one strategy I test from academic papers just to see what works, what I can add to my portfolio, and what isn't working. If you want to stay on top, you need to know what's strategy working and what's not. The Substack link is in the description, where you can also read the full rules and research behind this article too. So the strategy started performing again. Smoother, steadier, and far more believable. I also made it long only, since shorting smaller liquid names is impractical in real life. This version of the system, with the volume filter and long only setup, finally began to show consistent strength again. Now to be clear, it's not perfect. No single volume filter can make a strategy bulletproof. But it's the difference between a broken system and one that still has life in it. I tested multiple look-back periods, 20, 60, 126, 200, and 252 days, combined with different rebalancing frequencies. And across that range, the system consistently showed similar behavior. 20-day ranking length is too fast, but 3-month rebalance works shows potential if you are using 3-month or half-year or 200-day ranking method. I also checked how many positions made sense. 5, 10, 20, even 50. The results didn't change much, which tells me the edge comes from stock selection, not portfolio size. I also tried limiting the universe to SPY constituents instead of the full NYSE. So, what's next? The buy winners, sell losers strategy, the one that delivered 30% per year in the 1990s, doesn't work the same way today. But the core concept isn't dead. It's evolved. Today, momentum still exists, but it's hiding in smaller, less liquid names. It requires cleaner data, realistic trading costs, and proper filters to uncover. If you apply those adjustments, you can still capture an edge. Not the flashy kind that wins every year, but the steady, robust kind that survives across decades. That's the story of my backtest. You can download the real test code and full step-by-step rules to try it yourself on my Substack. And if you want this trading strategy, join with Substack today.